So, hello everyone, good evening or good late afternoon. So, I'm Martin and I will present today on the topic how to earn passive income with the DeFi. Now, okay, we did usually these seminars on Sundays, but we realized Sundays are not so perfect for many people, especially as summer is coming, and now we are doing these seminars / webinars. We are doing them now on Mondays. We just switched over. Now, my past, I'm co-founder and CEO of SmartCredit.io. So before this, I worked 10 years as a vice president for Credit Suisse in Zurich. So this big private banking uh, uh, bank. Before this, I worked actually in the startup industry, and I jumped from startup industry into the banking. And I have as well MBA, CFA, and all related things, but they're relevant then for the okay, just to so I see we have now last time we had some scammers here on the meeting. Now they were taking over my screen, so let's see how it is going this time. So do we get some scammers or not? But anyhow, we will continue. We will then share this information. So then okay, wait, there is someone writing very much on the chat. Let me handle it. So I will just disable the chat for the time being, and let me continue. Okay. So previous webinars. So we have had now the webinars on the multiple topics like a coronavirus and Bitcoin price, coronavirus market crisis, coronavirus crash, and 2008 financial crash. We're speaking as well about the central banks. We have been speaking quite a lot, and as well Bitcoin, upcoming recession, so fiat currencies versus Bitcoin, and crypto lending platforms. So we are speaking about quite some topics, and the last session we had then Bitcoin halving impact, Bitcoin price and crypto market. Now our last session, it got hijacked for some scammers, so they took over my screen, so we stopped the session, but we recorded then the talk later and we're putting it on YouTube. Now, if it happens that today again some scammers are taking over my talk, we're just recording it later, we'll put it on the YouTube. So dear scammers, it doesn't make any sense to scam, we'll put it anyhow on the YouTube. Okay. Now, agenda for today, we speak about the crypto lending. So we looked in on the DeFi overview, and then this discussion, this passive income. How do we earn the passive income on the DeFi? I like we look on this, and as well then because I'm one of the co-founder of SmartCredit.io, we look like how is then SmartCredit.io accessing the DeFi challenges, and then we have questions and answers. Now it depends, of course, like to our scammers. I think today we have again one scammer here on the chat. Allow us to ask the questions, but I hope you can submit some questions. Then I will allow the chat then on the end of the presentation. Now let's continue. So then crypto lending overview. So if you look now on the use cases of the crypto lending, so there are three key use cases. So crypto lending. So we have trading. So we have liquidity needs, and we have a crypto industry. Let's go one by one of them. And so let's look first at trading. So most of the crypto lending, so if you're speaking passive income, so the passive income we will earn with the lending. And most of the crypto lending, it will go into the crypto trading. And this will go via the crypto exchanges. We look on the next slide. We have a little bit more on data of this. But this is the fact. So that the crypto industry itself is still emerging, and we see there is this position like a crypto industry, and the use cases, this is 10% of the use cases. So that we have here, 10% of the use cases are then just a crypto industry use cases, meaning crypto to crypto transactions. And the 10%, that's a middle position here, these are liquidity needs. And Okay, what does the liquidity need? It means very easily that someone has just some position, and he decides to then to use this position, to activate this position, to use this position as a collateral, and to get a stable coin, for example, and then to do something with these stable coins. So that's the liquidity needs. Okay, it's often because of the tax situations, or there are as well the wish to then to create liquidity on the illiquid assets. Now, okay, so we have like at these three typical use cases, and these are then the basis as well for the passive income generations. So because we have borrowers, lenders, now the lenders are lending the money. These are the use cases here. So the three key use cases. Now let's look now on the lenders, on the lender side. So on the crypto market, as we have, okay, this is all estimation now for 2019, and I will tell as well later where we are getting this data. Now, the crypto lending market, okay, which is then the key for the passive income on the crypto lending. Okay, the biggest players are the crypto exchanges. And what is it? It's a margin trading, margin lending. So let's take Huobi or OKEX, Bitfinex, Bit, but there are many of them. And practically they allow then the users to borrow, lend mutually, peer-to-peer. And but this is the biggest loan originations. Now, this is what we have calculated. Now, the second thing that we have, these are the custodial solutions. These are like Nexo, Celsius, Genesis Capital, okay, Salt Lending. There's some more of them. Now, these solutions, they are controlling your keys. So practically, they are like a wallet. You transfer your assets into their wallets, okay, into your wallets, but they control as well your wallet. They have access to your wallet. So you have access to your wallet and they have access to your wallet. And their business model is that they are taking the assets from your wallet and they are lending them out. So you as a user will then earn a passive income, but they are then the platform, they are then actively taking the assets out from your, they're taking actively assets out uh, from your, from your wallet and then lending them. So, okay, custodial solutions. Now, they are self-reporting their revenues, and now if you're adding Nexo, Celsius, Genesis Capital, Salt, if you're adding them together, we get a little bit lower than 15 billion for last year, the total lending volume. But then let's add a little bit more buffer for the other custodial solutions as well. There are more of them, so and we can calculate 15 billion. Okay, but they are then this custodial segment. Now, the focus on today's presentation, this is on the non-custodial solutions. This means these are the solutions where the platforms do not control your key, where the platforms do not have access to your assets. Because that's the idea of the old blockchain, that you will not, that you control your assets, that the others cannot access your assets. So practically that you disintermediate all the financial intermediaries that are there between. So practically the possibility of this disintermediation. So these are these non-custodial solutions. And this non-custodial solution, this lending, this is the DeFi lending. DeFi being the decentral finance, DeFi, this big marketing term, DeFi lending. Okay, again, the key difference is in the lending market, crypto exchanges, the biggest player, the most established player, then custodial solutions. The lending solutions, they control your keys, they actively take assets from your wallets, and non-custodial. No one has access to your wallet, you are the only one who controls your asset. Okay, let's continue. Now, if you are speaking of the crypto lending market as well, then let's be transparent here as well on the risks, and then we go a little bit more into details now. The risks, let's take these three categories, the crypto exchanges. Now, the crypto exchanges, the biggest risk here, okay, that's the honeypot hacking risk. Okay, we know a lot of crypto exchanges have been hacked. Okay, Mt. Gox, the biggest and most famous, but there are many others, very famous, maybe a little bit smaller. It's the honeypot risk. If there are too many assets in the same honeypot, too high motivation, increased motivation, then to hack it. Now, the second category, custodial solution, it's a honeypot risk. Of course, the custodial solutions are using then, like Nexo and Celsius, they're using the BitGo, multi-sig wallets, and so on. But let's be now transparent. The BitGo has insurance, it's on 100 million. Now, what happens if the assets are above 100 million? So and that's a BitGo total insurance for all their clients. So that means Nexo sales and tens of other clients are sharing the same insurance via the BitGo. Now, okay, custodial solutions, so honeypot risk is there. Okay, it's mitigated then with BitGo multi-sig wallets, the other multi-sig wallets, but it's still there. Now, and then we have non-custodial solutions. Okay, and there we have two risk types. Okay, related then to smart contracts. One is the smart contract hacking risk. So, okay, so some people might remember the DAO, like how the DAO was hacked. Was it 2017 or 16? I don't remember it exactly. But this was one of the first organizations on the more famous organizations which got hacked. And then the Ethereum chain was split into two between the conservatives and non-conservatives. So, and the other risk is there, the smart contract usage risk. It's not only hacking, like finding errors in the source code, it's as well using them in a way as they are written, but we are just using them, creating unwanted results. And the famous example is the BTCX, the exchange hack, which was pro usage hack. So it was now source code hack. So these are the three risks here. Like the risk categories: crypto exchanges, custodial solutions, non-custodial solutions. Now our focus is on non-custodial solutions, on the DeFi solutions. So this $2 billion from this, okay, circa 40 billion lending volume. The market is then a little bit smaller, but the lending volume in 2019. Okay, DeFi lending overview. Let's get it here now. So DeFi lending. Okay, if you're speaking of the passive income, then the passive income is then achieved via the lending. So we are the borrowing and lending. I have the assets, I'm lending them out, and the other party is then borrowing the assets and is then paying interest for them. So, and here we have like the, just to be listed like the key players. Of course, we consider ourselves as well a key player, so but we're going later to this. So now let me just uh, say it. So okay, the platform Maker is the first one, and Maker is creating Maker is the platform creating the dice. So it's a smart contract. You put Ethereum on a multi collateral in, and you're receiving your dice. Now you pay interest for this as a die creator. Okay, when you are creating dice, you have to pay interest for this. But now you have your stable coins, the algorithmic stable coins. Now the next ones, Compound and Aave. Okay, Compound was the first one, then Aave did most of the things that the Compound did, and they are more like the money markets. So it's the money market system. Practically, you're putting your funds into the bigger pocket, and this bigger pocket is then lending out these funds to the borrowers. So, and it's like a daily interest, right? It's like even smaller than the daily interest rate that is charged. So these are not fixed term loans; these are variable term loans, where the loan term can be like 1 day, 1.5 days, 30 days. It can be arbitrary. So it's like a money market fund in a traditional finance. You put the funds in, and it's just daily access to the funds to withdraw them if you want to do it. And then we have here three platforms as well for the passive income. You know, it's DYTX, so I don't know exactly how to pronounce these things. Then Nuo, Fulcrum, BTCX, and these are then the margin trading platforms. These are then the same crypto exchanges which are doing the custodial solutions. Now they are doing non-custodial crypto exchanges, non-custodial, meaning that the asset is then the assets are controlled from the wallet owners. So this is then this is what these three platforms are creating. So now, how are they then earning? Because they are offering as well the margin trading, and margin trading means one side is then lending the asset and the other side is borrowing the asset and paying the interest for this. So, and we see in all of these categories. So, okay, let's leave Maker a little bit aside, special case, but Compound Aave like a money market, or as well here in the margin trading systems, it's the interest. So it's the borrower who is paying the interest. And we looked before what are the key use cases for the borrower. The key use cases, these are the trading, okay, especially then on these systems here, on the three systems here on the right side. It's the use case, crypto to crypto use case, and it's the use case where we have like the liquidity needs, creating a liquidity. Okay, that's more the use case of a maker, so it's the maker use case. Okay, let's go on the next slide. So let's look now a little bit at the statistics. I took the statistics today around noon from loanscan.io, and this is offering good statistics so that we can see, for example, in this year, loans originated, then, okay, not by all platforms, but these are just some platforms here. These are Maker, Compound, and DYDX. So it's 1.3 billion in US dollar value. So, okay, um, that's a very nice. So this will be this year more than last year, and we see as well the how much has been issued then for the currencies, like Ether, Thai, USDC, the sites, multi-collateral Thai, and some other ones. So we see where the focus is. The focus is on the Thai, so on the Thai borrowing, the Thai lending. So let's let's go to the next one. So the collateral ratios. Now, if you're looking at the collateral ratios, all of these loans, they are collateralized. So, and we see here the weighted average, it's a 490% collateral loan. And on the right side, we see per system. Now, I took it as well today around noon. So we see Maker has it rather smaller collateral ratio, but Compound, others, they're rather higher, and we see the weighted average going to 480%. So that means the borrowers are ready to put down 480% collateral to borrow. Let's say you put down 480 units to borrow 100 units. Okay, so that's the collaterals, over collateralization. Here we see the interest rates, and we see as well that the interest rates, okay, because most of these platforms have variable rate interest rates, so we don't have here fixed term interest rate, we don't have here any yield curve, so we don't have it here. So this is practically what we see, that the interest rates, and we see as well like quite some volatility on these interest rates. Now, how to read these interest rates? Now, the demand for Thai is bigger. People are ready to borrow Thai when they expect that they can use Thai, for example, buy Ether, buy some other coins, and the value of these other coins is going up. Then they are ready to pay higher interest for them. Now, if the expectation is there that the rates are not growing like the others, then the opposite is happening, and then the interest rates of Thai are rather going lower. So I say that the key driver here on the market, these are the crypto exchanges, this is the margin trading for the borrowers, lenders, and that means as well the expectations about in which way the Ether is moving will influence the interest on the Thai and on the other crypto assets. Okay, let's move on. Let's look the next statistics here. Okay. And there is as well USDC. By the way, just these two lines. The upper is for the borrower, the lower is for the lender. So some platforms are taking then the spread, but between the borrower and lender, that's then the profit of the platforms between. Now it's as well USDC, so we see it's from 1st of January from this year till today, and we see as well different interest rate, and the explanation why the interest rate is different, because it's a margin trading. It's high interest rate means the margin traders are expecting that Ether and others are going up, and vice versa. So the interest rates are a good indicator of the market mood. So, and here is as well the interest rate for the Ether. So we see, okay, and now let's get here to the collateral ratio. Oh, I think collateral ratios are, we looked already, slightly outdated slide. And here now the collateral liquidations. So we spoke about the collateral. So that means the loans on DeFi, they're using collateralization. as a security. Now, there is only one risk management method, that's collateralization. And we looked at our previous slides that this collateralization ratios are pretty high. Now, although they are very high, there are some liquidations. So, but we see the amount of these liquidations are rather very small, which just indicates how much over collateralized the crypto lending is at the moment. Plus, we have to consider as well that the liquidations. We have one more slide about the liquidations. Liquidations which are done on the DeFi platforms. Either they're using the platforms are using their own liquidation mechanism between their own users, or they're using decentral exchanges. So it means that if the liquidations would be done via the, let's say, central exchanges, then probably this liquidation ratio, because market efficiency, will be much smaller. Okay. So, but it just indicates the loans are over collateralized. Okay. Now let's look here now how to earn passive income with the crypto lending. So, because that's what we want to say, let's explain how this works. Working collateral based non-custodial lending. Let's go through the steps. We have a borrower, we have lender. Borrower enters loan request, and he has to submit down his collateral. So he has to deposit his collateral either in the money market fund or in the direct loan request that he's then submitting. So now the lender then accepts the request, transfers the funds, be it in the money market fund or be it in the other party who is then accepting it and will transfer the funds. Now, and here we have a little Ether icon as well by the borrower. Now the next one, let's look on the next one. So the borrower pays the loan. So that means he pays back the loan and the interest. Now we call this loan contract here the smart contract. They're just a loan contract. Now different platforms are using different names for these contracts. That's practically like this. And then the loan contract is then paying back, paying the interest to the lender, and the collateral is moving back to the borrower. So that's the basic flow. That's how the systems are working. So there's a collateral, there's an interest payment, and so on. And again, the collateral is the only mechanism of risk management on these platforms. Okay, let's go next. Now, okay, which assets are supported? And actually, the choice of assets is quite limited. Now, if you're looking on the compound, okay, of course, we have Ether, we have USDC, we have TAI and SAI. Okay, the SAI is then the single collateral TAI, and TAI is then the multi. Then there's Augurs rep, then a wrap BTC, meaning a BTC which is then locked on the BTC chain, and there is the one-to-one mapping then an Ethereum chain, 0x on the PIP. So we see the choice is quite small, considering that Ethereum has like hundreds, thousands of different tokens now. But it's the limitation here. The limitation here is always the liquidity. It's the liquidity for the liquidation. Now, if the loans need to be liquidated, then the assets have to be sold. Now, Compound has its own liquidation mechanism, but even if the users who are participating in the liquidation mechanism on Compound, they will use decentral exchanges. Now, and so they are depending on the liquidity on decentral exchanges. And decentral exchanges, their liquidity is quite limited. And as well, it's the order books, or how should we say it, pretty shallow. There are pretty limited orders inside. So okay. Now, and then on the right side, we see, for example, Fulcrum, the margin lending platform. It has some more coins, but we still see that it's a limited number of the assets. Why? Again, okay, we said it before, because the liquidity on these assets on the decentral exchanges is limited. So these platforms can use only these assets where the liquidity exists. Okay, now liquidation of loans. We have then these two mechanisms. Okay, let's speak again. The own liquidation mechanisms. Okay, these are the Compound and Maker. Okay, Compound, if the loans are collateral value to the loan is sinking to 150%, then people can ask to be liquidators for these loans. Okay, but probably then they use then decentralized exchanges to further continue the liquidation. Now, meaning they need then the liquidity of these underlying assets, which limits then the number of the collateral that can be used. Now, there's a second set of systems that are using the DEX for the liquidation, but is someone using the first or the second? It doesn't make a big difference because the first is feeding in the second one, so everything depends on the DEXs. Now, the more liquidity on the DEXs, the more tokens can be supported, and vice versa. And this is the reason why we have pretty limited number of the collaterals and pretty limited number of the underlyings. Then on the decentralized lending platforms. Okay, let's continue now. How to earn passive income? So practically, okay, after this long introduction, so these are these key mechanisms. So we have the money market mechanism. So the compound and our, so most well known. And we have margin trading platforms, okay, DYDX, Fulcrum, and Nuo. So, but we see there's something quite big missing. So we have money markets, we have margin trading platforms, but what is missing is are the fixed loans, and that's the area then where the SmartCredit.io is focusing. So, because it's not only that everything is invested and financed daily, so it's as well longer term loans, because anticipation is very simple. The elements which have been existing on fixed income markets and traditional fixed income markets for hundreds of years, they will be as well repeated then on the crypto markets. So, okay, we see these two key mechanisms here for passive income, and we think the third mechanism, like a fixed term loans, will be added in very soon. Okay, now after this, that it will be added something more, let's go on the SmartCredit.io approach. Excuse me. So how does it work? It's the previous things that we looked before. How do the how does the non-custodial lending borrowing work? So it's the same here. The borrower defines loan request, lender transfers the funds, all the same. Now, what we are heading here is we are creating, okay, it's done here in the example on the based on the ether. So what we are doing is we are creating here the CC ether, which then represents the underlying loan. So we call them credit coins. CC as a credit coin, and ether, CC ether means credit coins are created based on the ether. Now the credit coins are interest bearing, and the lender can transfer the credit coins then to other participants. So, and now there is a step where the borrower is paying back the loan. So it's going to loan contract. And what we are adding here now, there are multiple steps here. Let's go first here. We see on the right by the third party, not the lender, is receiving the interest payments and the principal payments. Then the collateral, of course, is given back to the borrower, and we have a loss provision fund as well, which is getting in the part of interest by a formula. So, and that's what we are adding. So we're adding then some additional mechanism into this traditional DeFi system. So this is described in the simplified mechanism here on this slide. Okay, now that means SmartCredit.io approach. Let's go through and let's go the key elements here. The first is low collateral ratio. What does the low collateral ratio implies? Now, if you look before, then today the weighted average collateral ratio for the DeFi is 480%. In our system, it will be 200, below 200%. Okay, of course, depending on the fixed loan duration, so fixed loan term. Now, low collateral means that the borrower can borrow more on his assets. Now, this crypto lending, the lenders are receiving the interest, but the borrowers are the moving force of this market. Now, when borrowers want to borrow, the others can lend. Now, if borrowers don't want to borrow, the others cannot lend. And if borrowers can use less collateral, it means they can borrow more on the collateral. So, and that's like a key principle, that the collateral should be rather smaller and not 480%. The second thing is like tokenization of the loans, like we looked on before, that we are creating the credit coins on the underlying, so credit coin ether, credit coin TAI, CC ETH, CC meaning transferability of the loans. Then we have private fixed income funds. Now, we looked here Compound and Aave, they have the money markets, very good. But in a traditional finance, we have the concept of like a fixed income funds, which are one step after the money market. So we have a fixed term loans. And this is then the idea. These are the private fixed income funds, like just pre-configured fixed income funds where the lenders can just define them for themselves. So lenders just define on which maturities they want to invest. And the system will invest it some. And then the keys as well that we're doing fixed term loans. We are not doing variable term loans, but our focus is on the fixed term loans. Like on this key element of the fixed income, like it exists for hundreds of years, which is then getting more populated as well into the DeFi. Now, why do we need fixed term loans? Because it's for the way for the borrower to protect himself. There's a way for lender to secure his income. Um, Now, if you're on the variable thing, like we saw in the interest rates here, the rates can move up and down. So both sides are taking the risk. Now, fixed term loans, it just means that the interest rate risk is then reduced. It's not reduced. It's taken away from the picture because the interest is fixed, not the case on the variable rates. So that means the more the markets are maturing, the more we're getting as well fixed term loans into this picture. Okay, now, and then as well, let's add this slide here. Okay, capability to borrow. Let's think again. We have here two arrows. One is for Maker, Compound, and Aave. We see the capability to borrow, and smart credit is a factor 2, factor 2.5 above them. Maybe in case of Compound, even factor 3 or more. That means borrower can borrow on the same collateral 2 to 3 times more than on the other systems. This is what the smart credit is adding. So fixed term loans, and borrower can borrow much more than the others on the other platforms. Okay, so the summary. So let's say it this way. So crypto lending has become a significant market. So 40 billion total lending volume last year. It is a market already. Now the biggest share of this crypto lending is via crypto exchanges and custodial crypto solutions. Now, and the DeFi, meaning non-custodial DeFi solutions, they have $2 billion lending volume. But it's growing, and we looked on this picture, we looked what is happening, we looked as well what we think what will develop as a next. So now I will say let's go to the questions. I will enable now the chat. So then please submit your questions. So I will wait a little bit just to see like will there be some questions asked. Okay, here is a question. I will read it. Why is interest to USDC and the TAI different? Well, um, very good question. Now, if I'm thinking so, I have to say I don't have direct answer, but what it can be that in case of USDC we have an easier access to the fiat. Now, if you have DAI, then the fiat conversion it's maybe more cumbersome than in the USDC, and maybe this divergence is coming from this. Now, the other parameter can be that okay, it's like on which exchanges is USDC present, on which exchanges is DAI present, not just present, but being a trading pair with significant volume, and this can impact as well the demand for these currencies. Because let's think the main users are the crypto traders now, and if crypto traders are on some exchanges where USDC, for example, is used more in the trading pairs, and where the crypto traders are then going when the expectation is that the assets are increasing, then they will margin borrow the USDC. Um, okay, so I cannot answer it exactly. Let's look at the next question. What is the duration? Probably what is the term of USDC loans? Now, if you are looking here on this this model, practically all of this DeFi model is so practically like a daily loans. So you have a daily interest rate, or you have an interest rate which is continuously changing. So it's like a money market fund. So that means the term is just a 1 day. Um, so meaning the interest can one day can be pretty high, another day can be pretty low. So depending on the market mood, like if the market mood is as the market is moving up, interest is going up on these stable coins, and vice versa. So that means the term, okay, technically speaking, is one day. Okay, let's look some next questions. Do we have some next questions? Okay, so these were the questions. So I will then say thank you very much. Thank you for the listening. We continue with these webinars. Now, the fact that we got some little scammers here last week and that we got some scammers as well today in the webinar just shows uh, we are speaking something that is important for the people. This is an additional motivation for us to continue to do exactly the same thing. We will put the recording on this video on the YouTube, and we are very proud that we have received the attention of the scammers. We received it last week, we received it today. So like I said, thank you for everyone. You give us much more motivation. You approve that what we are doing is the right thing. Thank you for listening. Have a nice day. Till next time.